my name is Jocelyn Bergentos, and I'm gonna teach you a lesson or show you how to do it or take notes over it about monetary policy. So, contractionary policy expands the money supply more slowly than usual or even shrinks it. For expansionary policy, increases the total supply of money in the economy more rapidly than usual. For reserve requirements, it's a central bank regulation employed by most, but not all, of the world's minimum fraction of customers' deposits. For excess reserves, are bank reserves in excess of a reserve requirement set by a central bank. For checkable deposits, consists of any demand deposit account which checks or drafts of any kind may be written. Checkable deposits accounts include checking, savings, money market accounts. They also include kind of negotiable drafts such as negotiable order or withdrawal. For money supply is the entire stock of currency and other liquid instruments in a country's economy as of a particular time. The money supply can include cash, coins, and balances held in checking and savings account. For the difference between fiscal and monetary policy involves changing the interest rate and the influencing of the money supply. Fiscal policy involves the government changing taxes rates and levels of government spending to influence aggregate demand in the economy. They are both used to pursue policies of higher economic growth and controlling inflation. For federal fund rate, the interest rate at which a depository institution lends funds maintained at the Federal Reserve to another depository institution overnight. The federal funds rate is generally only applicable to most creditworthy institutions when they borrow and lend overnight funds to each other. So we are going to start now with the questions. So the first question is, in recent years, the Federal Reserve has made targeting the federal funds rate a main focus of its monetary policy. A. Define federal funds rate. The federal funds rate is the interest rate banks charge each other for overnight and short terms. So it's this one. So for letter B, in Federal Reserve wants to lower the federal funds rate, what open market operation will be appropriate? Well, if you look at all the banks, the best one, or like many of them, will be buy securities. That's the best choice to have. It deposits credit onto the bank's balance sheets, giving them more several than they need, more than what they need. So for point C, it's saying, assume that the open market operation that will indicate in part B is equal to 10 million. Sorry about this mess. So what we're gonna do, and then, so they give you 10 million, and 10 million is equal to ER. And then it says if the required reserve ratio is 0.5, calculate the maximum change in loans throughout the banking system. So 0.5 is going to be RR. So 0.5 equals to RR. And then 10 million will equal to ER. So now the equation is, it's going to be 1 over RR, right? So now what you will do is going to be 10 times 1 divided by 0.5. So let's do that. Take out your calculator and plug it in. So 10 times 1 divided by 0.5. is going to be equal to 20. So that would be your answer. They can only loan that. So now let's go on to part D. Indicate the effect of the open market operation that you will indicate in part B. So in part B, on the nominal interest rate. Well, in part B, it says if the Federal Reserve wants to lower the federal funds rate, what open market will be approachable? So the answer would be buying securities, as I said for part B, which reduces nominal interest rates. So that's it. For part E, assume the Federal Reserve's actions result in some inflation. What would be the impact of the open market operation on the real rate of interest? The real rates fall if FD buying reduces nominal rates and inflation further reduces real rates. So that's all we got for today. I hope you learned something from me, and I hope I taught you well and you understood what I said. And that's it for today.